Let's kick off this explainer by running Pentair through our ultimate test, the Guru Gauntlet. We're going to take this stock and look at it through the eyes of absolute investing legends, Warren Buffett, Peter Lynch, and Benjamin Graham, before stress testing it with some modern valuation models.
Here is our game plan for today. We'll start with a quick snapshot of the business, apply those 3 legendary investing lenses, build out a modern discounted cash flow model, and then wrap it all up with a final verdict. Let's dive in.
Section 1. Let's establish exactly what we're looking at with our company snapshot.
Meet Pentair, trading under the ticker PNR. They are a massive $12.15 billion global water solutions company, trading right around $75.18 a share. Basically, they're in the business of sustainably moving, improving, and enjoying water. We're talking residential and commercial water solutions, pool equipment, you name it. And here's the kicker. They were just recently crowned a dividend king. That means 50 consecutive years of dividend increases. Literally half a century of returning consistent cash to shareholders. Not too shabby, right?
Okay, moving to Section 2. Let's apply our first framework, the Warren Buffett lens.
Channeling the Oracle of Omaha, we're hunting for a wide economic moat and rock-solid financials. And Pentair? Well, it actually checks a lot of his boxes. They've got a highly defensible economic moat built on sustainability and essential recurring water services. Because let's face it, water isn't going anywhere. Management has been absolutely killing it too, delivering an impressive 16 consecutive quarters of margin expansion. Financially, we are seeing consistent earnings growth backed by a super solid 17.07% return on equity. The debt is totally manageable, just 1.91 times net debt to EBITDA. And the big one for Buffett, owner earnings. They are sitting on roughly $748.4 million in projected 2025 free cash flow. Honestly, Buffett would love the business fundamentals, but as we know, he demands a margin of safety on the price. We'll get to the actual valuation in just a minute.
Section 3. Let's throw on the Peter Lynch lens and see what we find.
Lynch would almost certainly tag Pentair as a stalwart. A dependable, slow but steady giant with that insane 50-year dividend streak and a hyper-reliable cash flows. You don't buy a stalwart hoping it'll 10x overnight. You buy it to compound steadily and protect your downside when a recession hits. Now for valuation, Lynch loved the PEG ratio, which compares the price-to-earnings multiple to the expected growth rate. Pentair's PEG ratio currently sits at 1.27. In Lynch's universe, trading that close to 1.0 means the PE ratio is perfectly reasonable compared to how fast it's growing. So you're paying a very fair price for its trajectory.
Oh, and it gets even better for the Lynch case. Management just bought back $200 million in shares in the first quarter of 2026 alone. Lynch absolutely loved insider buying and share repurchases. It is a massive green flag that basically screams, we have immense confidence in our own balance sheet and future prospects.
Let's keep rolling. Section 4. What happens when we apply the famously strict Benjamin Graham lens?
Going rapid fire through Graham's defensive investor checklist, Pentair puts up a really strong fight. Adequate size? At a $12.15 billion market cap, definitely a pass. Strong finances? Their current ratio is 1.88, which is just a hair under Graham's strict 2.0 target, so we'll call that close. Earnings stability and dividend record? With consistent EPS growth and 50 years of payout bumps, those are easy passes. A moderate PE of 18.44 easily slides under his limit of 25, but here's where it hits a wall. It fails on the price-to-book multiple. At a PD of 3.19, multiplying the PE and PB together blows past Graham's strict mathematical ceiling of 22.5.
So this brings us to calculating Graham's famous intrinsic value formula to find our absolute rock-bottom floor. The math is the square root of 22.5 times earnings per share times book value per share. So we plug in their 2025 GAAP EPS of $3.93 and an estimated book value of roughly $23.56,
And we get a Graham fair value of exactly $45.64. Ouch. That means at today's $75 price tag, a strict value investor would demand a massive pullback before even thinking about touching the stock. Now, Graham's methods are famously brutal, and very few modern companies pass in today's premium price market, but it gives us an excellent anchor for the absolute worst-case downside.
All right, let's step out of the history books and into Section 5, DCF and alternative models.
To build our modern discounted cash flow model, we're starting with a base here of $748.4 million. That's the projected 2025 free cash flow. We are going to project that out 5 years at an 8% growth rate, which completely aligns with management's own EPS guidance. To fill in the remaining gaps, we'll use an industry-standard 8% discount rate for the weighted average cost of capital and a standard 2.5% perpetual terminal growth rate.
And this brilliantly illustrates our findings in a sensitivity table, because let's be honest, assumptions can be wrong. Looking right at the center, our base case fair value sits at $96.67 a share. Even if we get really pessimistic, say we crank the discount rate up to 9% and drop terminal growth to 2.0%, the fair value is still $73.80. That's basically right around where it's trading today. So at $75, you're actually getting a very healthy margin of safety relative to our $97 base case estimate.
Let's look at some other valuation models to really triangulate this price. This chart compares the current price to two completely different methods. The dividend discount model, which values the stock purely based on future dividend payments, gives us a highly conservative $57.24 floor. That's assuming their current $1.08 dividend and a moderate 6% growth rate. On the flip side, if we just look at comparable historical PE multiples, it points to a much higher ceiling. If Pentair just returns to its historical 20x PE multiple, applied to the midpoint of their 2026 EPS guidance of $5.35, we're suddenly looking at a fair value of $107 per share.
We have officially survived the gauntlet. Section 6, Synthesis and Final Verdict. Before we look at the final matrix, we have to weigh the real-world qualitative factors. Pentair has some incredible strengths, right? 16 consecutive quarters of margin expansion, elite dividend king status, and a really strong 2026 EPS guidance upgrade predicting 8 to 10% growth. But there are very real risks here. Management has actively warned us about looming destocking headwinds in the residential pool segment, which could negatively impact shipments in the coming quarters. Plus, they actually posted negative $86 million in free cash flow for Q1 2026, though they do attribute that to normal seasonal working capital outflows.
Blending all our lenses into one master matrix, here is the final picture. For Buffett, it's a fantastic moat, but he'd probably want a slightly larger margin of safety, so it's a hold. For Lynch, it's a textbook stalwart with a totally fair 1.27 peg and massive share buybacks. That is a buy. Graham's strict intrinsic value says the price is way too high, so that's a sell or wait. But our modern DCF points to a fair value around $97, and historical comps point to $107. Both of those signal a buy. Put it all together, and Pentair emerges as a highly resilient hold to a cautious buy for the long-term investor.
The models have officially spoken. We've got a range stretching from a conservative 45 floor all the way up to a $107 ceiling. But ultimately, the required margin of safety you need is totally subjective. It comes down to your own portfolio and your risk tolerance. So, based on everything in this gauntlet, at what price would you pull the trigger on this newly crowned dividend king?